Time to talk finance, personal finance, thanks to our partners Forsyth Barr. 7 US tech giants have collectively lost more than $1 trillion in stock valuation in the last week as confidence in AI wavers a little bit. After years of growth investments dominating the markets, is this the sign for investors to change their strategy? Mark Richardson is investment advisor with Forsyth Barr with me this morning. Mark, good morning.
Yeah, morning.
Yeah, so first of all, what is the difference between growth and value investing?
It's probably a good way to start, actually. So growth, and you mentioned the big tech stocks. So companies where they're priced for future earnings. So you're paying a bit of a premium now, but you're looking at what they're doing, and in 2, 3, 4, 5 years' time, you're thinking they're going to be making a lot of money, and so you've paid for that now. So another example of that would be your medtech, guys who are developing these sort of flash medical devices, and a lot of money's going into research and development there. You're paying for what these going to do down the line. Value, on the other hand, is more sort of established sort of companies. Think maybe financials, energy, consumer staples. These are companies that may be a little bit underloved, but
they're making money.
They're making their fundamentals are great.
Yeah.
The market's probably underloved them a little bit. You look at that and go, that's good value. I'm paying for what I'm getting now. And then the theory being that finally the market wakes up and realizes, hang on, this is a good business, and then you get the capital gain on top of that.
Yeah, and because everyone gets a bit carried away, don't they? A bit flirty with all of the darlings of the stock market. When your tried and true, your workhorses can get overlooked.
Well, we look at it, a lot of these companies now, these big tech companies and some of these big companies that we would call growthy companies, are priced for perfection. So if every time they come out, you're going, that was a good report. They're making profit. There's lots of cash there, and it drops 5-6% because the market is so demanding. It's wanting it to keep delivering on these high expectations. Whereas you've got some other companies that they're overlooking that are going, hang on, they just keep churning away. So I don't think you want to, if you're going, okay, well, let's get out of growth. You don't want to go black and white on this. I think you just look at the situation, and you might start to just tilt a little bit. So you add a little bit more value, maybe take some of the gains or protect some of the performance you've had over the last year with the tech and the growth.
Do you think that some of those growth, the AI companies in particular, are overvalued, have been overvalued?
Well, as far as I look at them, and this is the big question that is facing everyone at the moment. You look at them and you go, okay, the definition of a growth company, let's say, is maybe a new building company. Well, these are big established companies. They've been here for a long time. They are generating revenue. They are have sit on mountains of cash. But the growth is all around what are they doing with AI? Is this the next industrial revolution? How much is AI going to turn these already behemoths into something even bigger? So that's the growth aspect of these companies. That's where the question lies.
Yeah, and then the other thing is earnings. And I think actually we had this conversation like a month ago, before you went away, before I went away, about AI and about the dot-com bubble and how the valuations, the earnings compare for these AI companies versus some of the dot-com companies back in the day.
Yeah, well, these companies right now are actually established companies making money. That's probably the big difference is, they have got machines. This is where I think, Meta, who are, and we were talking about earlier on, Meta, who are investing heavily in AI, they don't, their capital expenditure on that, where that scared the market to a certain extent, is that they don't have this cash generating machine that's operating in terms of data centers, things like that Amazon does, that Google, Alphabet has. They're basically going, okay, well, this is slightly different. We're an advertising company pretty much. When you think about Meta, now we get into AI, and it's like, oh, you're spending a lot of money. How are you going to deliver on that?
Yes.
So all of a sudden, people are going, whoa, are they going to get the growth we expect? Markets questions that, and then you see the pullback.
And will consumers pay for the AI product? That's the other thing, right?
How do you make, when you're developing new products, one of the toughest questions, I'm not a researcher or analyst, okay?
Yeah.
I'm an investment advisor.
All right.
Is how do you monetize your new products?
Yeah.
It's one of the biggest questions for a company.
Totally. Mark Richardson, always good to see you. Mark Richardson, investment advisor at Forsyth Barr. Thanks to our partners, Forsyth Barr.